All right, welcome everyone. Today, we're going to tackle a really fundamental idea in accounting, something that honestly trips a lot of people up. We're calling it the profit paradox. And look, this isn't just some abstract theory. This is one of those concepts that really separates the good managers from the ones who, well, can accidentally run a perfectly good company right into the ground. So, getting this right is absolutely essential for your careers. Let's dive in.
So let's start with the big question, the one that's at the heart of our discussion today. Is it possible for a company to look great on paper, reporting big profits, getting all the stakeholders excited, and then suddenly it's filing for bankruptcy? How on earth can both of those things be true? It seems like it breaks all the rules of logic, right? But it's not about flawed logic. It's really about misunderstanding what our financial statements are actually trying to tell us. So our goal here is to pull this scenario apart using some core accounting principles.
And this is what we call the profit paradox. I really want you to understand that this isn't just some weird theoretical thing that only happens in textbooks. This is a real-world challenge that managers, investors, and even banks deal with all the time. Being able to look at a company's reported profit and see how it connects or doesn't connect to the actual cash it has, well, that's a fundamental skill for making smart business decisions. So, yeah, it seems totally impossible, but it's a story that plays out over and over again. And the answer isn't buried in some super complex financial scheme. No, it all comes down to one single foundational accounting principle, a principle that draws a clear line between when we recognize that business activity has happened, which is profit, and when the cold, hard cash actually moves, which is, of course, cash flow. The key that unlocks this whole paradox is a concept accountants call timing issues. Really getting a handle on this is what separates a basic bookkeeper from a sharp financial analyst. It's what lets you look past the headline profit number on an income statement and really figure out if a company can pay its bills and survive. It's the difference between just reading numbers and actually understanding the story they're telling. Okay, so let's get a formal definition on the table. In the world of accounting, we operate under a set of rules called GAAP. That's Generally Accepted Accounting Principles. And under GAAP, most businesses use something called accrual basis accounting. Now, the whole point of this system, as you see here, is to give a much more accurate picture of a company's performance during a specific time period. It does this by following the matching principle. The idea is simple. You have to match the revenues you earned with the expenses you had to pay to get those revenues, and you do it in the same period, completely regardless of when the cash actually shows up or leaves your bank account. And that intentional separation is exactly what creates these timing issues. This slide just lays it out perfectly. We're really looking at two totally different realities. On the left, you've got profit. This is all about the revenue recognition principle, which basically says you record revenue when you've earned it. So you've done the work, you've delivered the product. It doesn't matter if you've been paid yet. Then on the right, you have cash. And cash is simple. It's just about when money physically comes in or goes out. A huge mistake, and I see this all the time, is treating these two as the same thing. They're not. They serve totally different purposes. Profit tells you how effective your business operations are. But cash tells you if you can survive. Okay, so the theory is crucial, but let's be honest, the best way to make this stuff stick is to see it in action. So let's walk through a simple case study and watch how these principles play out in a real business scenario. So let's imagine a small company called Artisan Web Design. And for a moment, I want you to put yourself in the shoes of the owner. You've just landed a huge new client, a big contract. From a sales point of view, you're probably feeling fantastic. Business is booming, but now let's put on our accountant hats and see how we're actually going to record what happens next. Let's break this timeline down piece by piece. In December, they sign the contract. Now, that's a great business event, but in the world of accounting, nothing really happens yet. Why? Because they haven't done any work. Fast forward to January. This is the key month. They do all the work, they deliver the website, they send the invoice. This is the moment value was created. So, based on that revenue recognition principle, that full $10,000 is earned in January. But wait, they also had to pay $2,000 for software to do the job. And the matching principle says we have to record that expense in the same period we record the revenue it helped generate. So that gets recorded in January too. Now notice the huge gap. The client doesn't actually pay until March. And it's in these gaps, these timing differences, where all the financial risk is hiding. All right, now for the main event. We're going to look at this exact same series of events from two completely different perspectives. First, through the cash lens, what's actually happening in the bank account, and second, through the accrual or profit lens, what the official performance report says. And as you're about to see for the month of January, these two lenses tell two wildly different stories. Okay, first up, the cash view. I want you to think of this as just looking directly at the company's bank statement. It's the simple, hard truth of what money is there. So in December, nothing happens. No cash in, no cash out. But then look at January. They get $0 from the client, nothing. But they did have to spend $2,000 on that software. So what's the result? At the end of the month, they are literally $2,000 in the red. Now, this is a really dangerous spot to be in. You can't pay your rent, your employees, or your suppliers with a promise of money coming later, what we call an account receivable. You need actual cash. So from a survival point of view, January was a really, really tough month for them.
But now let's flip the coin and look at the profit view. This is what you'd see on the company's income statement. So because they did all the work in January, under accrual accounting, we recognize the full $10,000 of revenue right then and there. Then we apply that matching principle and we subtract the $2,000 software expense from that revenue. And what do we get? A monthly profit of $8,000. So on paper, January was an absolutely fantastic month. Operationally, the company was a huge success. They were incredibly profitable.
And right here, this is the paradox in black and white. For the exact same period, the month of January, Artisan Web Design was, at the same time, a highly profitable company and a business that was bleeding cash. Both of those statements are 100% correct from an accounting standpoint, and this is where the danger lies for a manager. If you were just looking at that profit number, you might think, great, let's hire someone new, let's expand. But the cash reality tells you the business couldn't even cover its bills. So why do we hammer this point home so much? Because managing a business isn't just a classroom exercise. These numbers drive real decisions with real consequences. The income statement and the statement of cash flows, they tell two different but equally important parts of the story. A good manager has to be fluent in both languages to get the full, honest picture of a company's health.
You hear this saying a lot in finance, and for good reason. It's spot on. Think about it. Profit is an opinion, because we have to follow all these rules and make estimates to calculate it, like when exactly revenue was earned or how to depreciate an asset. It's a very educated, well-structured opinion, but it's still built on rules and judgments. Cash, on the other hand, is just a fact. It's the undeniable, objective amount of money you have. To really analyze a company, you need both, the opinion on performance and the hard fact of survival. So let's wrap this up with the key things I want you to walk away with. First, and this is the big one, you need to burn this into your brain. Profit is not the same as cash. It's an accounting measure of performance, not a measure of your bank balance. Second, the reason for the difference comes down to those timing issues we talked about, which are a totally normal part of accrual accounting. Third, getting this concept down isn't just nice to know for a future manager or investor. It is absolutely essential. It's what allows you to look past the shiny profit number and truly understand if a business is built on a solid foundation or on shaky ground. And I need to be crystal clear about this. Accrual accounting is not some kind of trick. It's not designed to fool people. It's actually a really sophisticated tool that gives us a much better, much smoother picture of how a company is performing over time. Think back to our example. If we only recorded the $10,000 in March when the cash came in, it would look like the company did nothing in January and then had a huge random spike in March. That's not accurate. Accrual accounting correctly shows that the real value was created in January. The trick isn't in the accounting. The trick is learning to read both the income statement and the cash flow statement together to get the complete picture. So I'll leave you with a question to think about. Now that you know that a big profit number can be, a little deceiving on its own, what's the next logical question you should always ask when you're looking at a company's finances? When you see that headline profit number, what's the very next financial statement you should immediately flip to get the full story? The one that gives you the facts, not just the opinion. I'll let you think on that. Thank you.